Okay, welcome everyone. Uh, my name is Phil Francois. Appreciate you all stopping by, going live today. What we're going to talk about is tax advantage accounts, specifically tailored a little bit towards high income earners. Although this will be a beneficial discussion for really anybody. I'm going to address a couple common misconceptions about these, and maybe just kind of lay out a little bit of some pros and cons, some comparisons, what you can use together, what you need to use separately, and hopefully provide a little bit of context around how to use these accounts to the fullest to make sure that you're maximizing the benefits that you're getting while trying to manage various tax liabilities now and in the future. So again, my name is Phil Francois. I am a certified financial planner and have a firm called Foundation Wealth Planning. We typically work with high income professionals and business owners, especially those that are Catholic families that want to integrate faith in finance, while also doing that in a prudent way, managing their money. So what I want to do is go through a few of these slides for tax advantage accounts, and if you like some of this stuff, let me know what other topics you want me to talk about. I want to be able to do more of these live streams and videos and be a resource to those, whether you work with us or not. I want this to be a place that you can come and find quality information, because I know there's a lot of stuff out there that's maybe not as quality. So if you like the video, if you found some value in it, please like and follow me, subscribe to the channel, wherever you're finding me, and love to stay in touch. If you have some comments, feel free to pop in on the live on questions or comments, and we'll address them as we go. So without any further ado, tax advantage accounts, that's typically going to be, we're going to go through the retirement accounts specific to that. I'll address kind of another one that is adjacent to it, and we're going to go from there. So let's see if I can get my my screen to work here. Oh, I stopped. I took my presentation away. All right, so now let's see here. All right, here we go. All right, so the first one we're going to talk about is the 401k. Now, this is obviously most people have access to this. A 401k is nothing. The name doesn't mean anything special; just refers to section 401-K of the tax code, and it is specifically an employer-sponsored plan. So this has to be used through a job. Now, why was this set up this way? Well, it was kind of initially a way to replace the pensions of old. Now that's been in the rearview mirror. It's interesting that you still have to have some sort of employment, but that nonetheless, you need to have a way to have income. So the 401k is that vehicle. It's an employer-sponsored plan. If you do the pre-tax contribution, so if you're in a really high income bracket, it can be really beneficial to put away at least $23,000 of your own money into this account. Have that help your taxes for this year. Now, one thing to keep in mind is that it's something that you're going to be deferring taxes to a later date. So if you're in a high income bracket now, you may think, hey, down the road might be better to just push and pay taxes then. There's some pros and cons to doing that, but that's ultimately what we're talking about here. The 401k, it's kind of the workhorse. A lot of people, when they make their first million, a good chunk of that is through their 401k at work. And so no shame in really taking advantage of that huge process. And if you're a self-employed person, a solo 401k also exists. And we're going to talk a little bit about another self-employed option here on the next slide. And I can maybe kind of compare and contrast a solo 401k, but really, really solid vehicle. You can do $23,500 this year. If you're 50 or older, you can do the $7,500. There's actually an additional, they just put an additional catch-up contribution for those above 60 in one of the recent Secure Acts. So nonetheless, we can put a lot of money in. You really get what people would consider free money through the employer match. And I would make sure that you're taking advantage of that. If you have the ability to get a match within your company, your employer is considering that as kind of part of your total compensation. So not just leaving free money on the table, it's really that you're taking away money that they intend for you to use, right? It's kind of part of when they think of their total compensation package, that match they're giving you is a part of that. And so it's actually money that they want you to use. It's there as kind of part of that. And if you're leaving it on the table, detrimental for you now and in the future, your employer would like you to have it. So make sure that you're enrolling in the 401k and make sure that we are taking advantage of all of the different options available there. Now, a few limitations, right? Some people don't like the 401k because it does have limited investment options, and limited in the sense that your employer is the one choosing them. So that's the common thing. Now, there are certain ways around that. Certain plans maybe have some additional options, but by and large, the employer is choosing the investment lineup. And so you got to be aware of that. And you have to work kind of within the constraints of whatever that lineup is. And some places have really great investment lineups and others not as well. You kind of just have to make best with what's available. And then, a key thing too is if you're going to be loading this up now, understanding you will be required to have required minimum distributions at age 73, which if you're young, that seems like a long way away. Really good time to make sure you're working with a good advisor or a good planner to help figure out how we're going to navigate those taxes down the road, because you are pushing them down the road, even if you don't see them right now. Okay. On to the next one. What's going on here? Okay. Now the SEP. Okay. So if we think about the SEP IRA, it's a simplified employee pension plan. And so what we're looking for is the ability for a self-employed person, someone that makes good money, but they don't have a traditional employer. The SEP is the place that most people look first. And the reason why SEP is often chosen initially is because it's very simple to set up. It's like I said, simplified employee pension. You don't have a lot of paperwork. You can, most custodians can just set that up pretty easily for you, or most advisors can set that up pretty simply. And you can trim it up to 20% of net income. The math is actually 25%, but then you have to back out a few things. It ends up being closer to 20% of your net income, up to $70,000 in 2025. Now, if you do the math on that, you got to actually make a pretty good chunk of money to do the 70,000. But nonetheless, that's a lot of money that you can put away, and that's going to be done as a pre-tax option. So again, it's a way to help lower your taxable income now and push that to the future. Now, they did put out some in the one of the most recent Secure Acts. They did say that a Roth SEP could be an option, although we're still really waiting on guidance. I don't really think any custodians are allowing you to do that at this point in time. In theory, it would be very cool to have a Roth SEP option. I don't think it's really that big of a deal. Now, if you do end up having employees, you got to be really careful, and not careful in the sense that you don't want to give your employees a benefit. But if you have a SEP, they have to be eligible, your employees, and you have to give them the same percentage, of their account. Now, that may be a less dollar amount because they make less, but they still have to be able to participate in the SEP. So you have to put an employer contribution into their account. They can't add to it. It's only your employer contribution. So if you start to add employees, you may want to transition over to a 401k, or just at least be aware that that's a thing. Now, the solo 401k would be the competitor to the SEP. So if you're self-employed, you could do either the SEP or the solo 401k. And there's some nuances there. Solo 401k would actually allow you to invest more if you make a little bit lower money. The max would be still the same, but you could do it at a lower dollar amount. Your lower income could let you do more. There's some math behind that, but the solo 401k is really great there. It also allows you to be eligible for something called a backdoor Roth IRA, which we're going to talk about later, whereas the SEP kind of inhibits that. So that might be one of the a big thing to look into for a solo 401k. However, the solo 401ks do take more time, effort, and energy to set up. There's more oversight, more things to be aware of compliance-wise. So they're not necessarily easy, but if you work with a solid professional or two to help you with running that, you can manage that for sure. All right, next one on the list. Oh, I went too far. Okay, Roth IRA. tax-free growth and withdrawal. So this is the fun one. And like I said, if we're high income, that means that oftentimes, and again, the definition of high income can vary, but if you're near one of the higher tax brackets, a lot of your employer plans are probably going to be pre-tax, so you're not really getting any sort of Roth growth if you're doing that. Now, adding the Roth IRA can be a really helpful piece, not only for tax-free growth, but just simply tax diversification. If you're having a lot of money that is built up in, say, for example, your pre-tax accounts, that creates a large tax liability down the road. And so we want to make sure we've got some tax-free dollars that we can also draw from in the future. So again, the benefits of a Roth IRA: tax-free withdrawals. So all the growth you get is going to be tax-free. There is some flexible access. You can get to your contributions without any penalties. I highly recommend against that. I don't like the idea of using the Roth with the idea that we want to get to those contributions early. But it does add flexibility in case life happens or you need the money for some reason. But I wouldn't open the account with the reason that that's why you get it. You don't have required minimum distributions during your lifetime, so you can let that money continue to grow and compound in there, especially tax-free later in life, and then potentially pass that on to your heirs or use it for later in retirement. Now, there are income limits to be eligible for this. So if you do have a 401k at work, there are going to be eligibility limits for the 401k. That is why we work with something called a backdoor Roth account. So I'm actually going to talk about that a little bit in a future slide, but the backdoor Roth would be the way to work around those income limits. And so something to keep in mind there. But so to clarify, the Roth IRA can be added to, you can have it with a 401k, you can have it with a solo 401k, you could even have it with a SEP. However, the SEP makes it difficult if you are over those income limits. You can't do a backdoor Roth IRA with a SEP IRA. So the Roth IRA pairs very well with a 401k, and it doesn't pair quite as well with the SEP IRA, depending on where you are income-wise. So keep that in mind. All right, so this is just kind of a boring, just dollars page, right? We can kind of compare the maximums. Now, the reason why the SEP is so much higher is because the SEP is operating under the employer piece. Technically, the 401k does have that same $70,000 limit, but that has to be added into what the employer does, or you can do something called an after-tax contribution to do a mega backdoor Roth, which I'm actually going to talk about that here in a second, because that's a pretty cool deal if you've never seen that. So anyway, just a few basics here, kind of running through the Roth limits of 7,000, SEP up to 70,000, but it's a percentage of your income, like I said, net of 20, and then the 401k. That's the employee contribution of a 401k. Then you have the employer contribution can add to be more than that. So be aware of that. It's a huge thing to take advantage of. And again, you can't really go back and retroactively add to these things 5 years ago. So if you've got good income now and you can take advantage of these things, this is the time to do it now, because you can't go back and say, well, hey, I wish 5 years ago I could put money in. There's just a maximum per year, and we need to try to take advantage as much of that as we can. All right, taking a part-time break here just to see if there's any comments or questions here as we go. I don't see any yet. So again, if you are enjoying this, please like, subscribe, follow me, and feel free to add some comments in if you have questions or anything as we're going along. Okay, so here's a couple things we're going to look at for some strategies or some things that we can help you with in terms of the way to think about some of this stuff. So like I said, the Roth IRA has an income limit. All right. And a lot of people stop there when we look at what are our options for the Roth. And so I've talked to countless people that have said, well, I make too much, I can't do the Roth IRA. And I will grant you the backdoor Roth is more complicated and more cumbersome than it should be. The steps It's really one extra step, but it feels like multiple extra steps, and it can really slow a lot of people down. So I highly recommend reaching out to a professional if you're over that income limit and you want help, a step-by-step guidance on how to do the backdoor Roth. Especially just to have someone walk you through it instead of, I mean, of course you can read it online as well, but just to know you can do a backdoor Roth, you have to make sure there's a few things to be aware of that make sure you're eligible for it. But that's how you get around the income limit. You do something called a backdoor Roth, which requires using a traditional IRA to get the money into the Roth account. And so anyway, that's kind of the basics there of putting the non-deductible in the IRA and then converting. You want to make sure you don't have any money in any sort of traditional pre-tax accounts before you do that, which again is one of the key things to be aware of before doing that. Now, when we're looking at priorities of maximizing primary accounts, right, the 401k, it says fill it first. That does vary. I'll put that caveat on there. It does vary by person and by individual, so put that caveat out there. But the 401k is certainly the workhorse. Like I said, it's got the biggest the contribution limits for employees, especially if you're making good income. It's it's through your employer. You can take it right off your check. It's really the simplest way to help maximize some of these first. And then if you're self-employed, you can look to either a solo 401k or a SEP, and then as needed, a Roth or a backdoor Roth. I think one thing that I look to help with clients with is balancing, your pre-tax accounts with your post-tax accounts. And so just having that tax flexibility, right? So having every single thing in one type of account, isn't necessarily the best thing, because sometimes you're leaving some money on the table that you could have taken a tax deduction today. Other things you're leaving on the table for tax help in the future with tax-free growth. So it's really trying to be able to balance that. And then don't forget about a couple of other cool accounts. Like the HSA is, if you have an HSA eligible plan, be sure to utilize the HSA, because that is a really great tax advantage account. It's not technically retirement, but it does mesh well with all this. I can maybe do another video around the HSA and other things around that, because there are a few nuances there. And then don't forget about just simply having a taxable brokerage account. There's no income limits to that. There's no distribution limits to that. You can add money and invest just in investments, but they don't have the tax benefits necessarily of a retirement account, but they have a lot of flexibility. And if you manage them properly, they can still be very tax efficient. And so making sure that we're having, some pre-tax accounts, some Roth accounts, and then also some taxable brokerage accounts. And again, how much you'd have in each one would vary based on your situation and tax and everything. But that offers flexibility by having, money in different buckets that we can pull from now and also in the future. And so being aware of that. And of course, like I said, have a professional in your corner. It doesn't hurt to have some professional help. And that could be done on a consulting basis, or maybe you want that as a more of an ongoing basis. But having some help along the way with getting these set up to make sure we're optimizing what we're using, making sure especially if you're making a big income, that you're taking advantage of being prudent with this income. God has blessed you with these wonderful resources, and He wants you to be able to take care of your family and the church and manage these prudently for Him ultimately, right? Because we're just stewards here. It's not our money at all. Just stewarding the money for God. And so as we're being prudent, here's just a couple of, real world type examples, right? So if you're a corporate executive, right, you're going to have the 401k. And again, if you're maxing that out and you're making a few $100,000 a year, most people would say, well, I can't do a Roth. All right. If you don't have any money in traditional IRA accounts anywhere, you could, in theory, do a backdoor Roth. So make sure you're pairing that together, and make sure you, again, take advantage of that employer match, which that would be fairly easy to max out and get all of that. Like I said, if you're making a few $100,000, that might be up to $12,000 annually that you're getting an employer match, depending on how they set that up. So that's just again a example. Not everybody's going to get $12,000 from their employer, so keep that in mind. Now, again, a self-employed physician. Now, this can work both if you're self-employed, just yourself, or if you have a hospital job, but then maybe you work as a contractor for another position or another facility or something, and you've got some sort of self-employed income. You could utilize a SEP IRA or even a solo 401k with profit sharing, depending on exactly how you're setting it up, to make sure that you're adding some additional tax deductions and saving yourself some dollars. So again, in this example, this person, based on how much they made, 65,000 was their maximum. But again, that's helping them with their taxes now for a tax deduction, and then allowing that money to grow tax deferred for a while. So keeping that in mind, again, just an example. And then of course, if you're some sort of tech entrepreneur, and you're not making a lot of money now, but you think you might hit it big, right? Maybe you focus more on Roth down the road, and then add some traditional down the road, or diversify with traditional accounts in the future. But depending on where you are, maybe you focus more on Roth versus traditional. So if you're early in that tech journey, maybe you do more Roth. Something to keep in mind. Again, those are just case study examples, not specific to you, but some things to keep in mind. Okay, home stretch here. Final piece of the pie. And account selection really does matter. There are pros and cons to each one. There is, in fairness, there is some speculation that has to happen, right? We don't really know what your income is going to be in the future. We don't know what the tax rates are going to be in the future. So we do have to have a little bit of kind of seeing in the future, and we don't really know that, right? That's speculation. So we have to know what do we know that are facts right now, and have to pair that and understand what are we speculating on, and try to make decisions where you're having as little speculation as possible. And that's where the tax diversification comes in. You can kind of help hedge by having multiple different accounts, pre-tax, post-tax, Roth accounts, taxable accounts, and just making sure that we've got a little bit of a combination in there. And having a professional in your corner, I think, is a big way to help do that, and making sure that we're maximizing that. And then just stay consistent, right? Start saving early, often, consistently, and high earners can benefit from that high income growth. So again, if you have the income now, making sure we're saving big chunks of it. If you don't yet have that high income, even just saving little bits now will really build to the future. I actually did a previous video on that. So if you haven't seen that, about the compound interest, please check that out. And it does make a big difference, even if you start small. And so without any further ado, that is the end of the presentation. And so I'd just like to say thank you for let's see here. I'm going to put myself, just me. Okay. So thank you again for anybody that stopped by. Again, my name is Phil. If you did like this, please let me know. Maybe share a comment or a like, share it, follow me, and I want to be able to do more of these videos. And I hope that's helpful. Purely education basis. If you want some personal specific help, please reach out to me. I'd love to be of service to you and help you out however I can. And otherwise, I appreciate you all stopping by, and God bless.